So we're going to start now this webinar. Good morning again. My name is Guy Menan, and I am the Research and Knowledge Manager with Making Finance Work for Africa. This webinar, Insights on the Investment Landscape in Africa, is actually the third webinar jointly organized by Making Finance and Riskera. The webinar is inspired by Riskera's flagship report called Africa, which provides in-depth information on 7 specific areas for this year. Investments, sources of capital, listed equity markets, private equity, sovereign bonds, infrastructure, and 197 participants have registered to today's webinar, which shows the relevance of our topic. We have a lot of materials to cover, and I will not take too much of your time. But before our esteemed guests outline the findings of this year's report, allow me to quickly introduce in a minute or two the Making Finance Work for Africa partnership. It's a G8 initiative hosted at the African Development. Our mission is the establishment of a common platform for the harmonization and facilitation of financial sector development and knowledge sharing in Africa. Other donors besides the African Development Bank include GIZ, the German agency, AFD, the French Development Agency, and Afrexim Bank, the European Investment Bank EIB, and Membusa, the Dutch Foreign Ministry. Making Finance Work for Africa focuses on 3 interlinked strategies. The first one being financial inclusion, the second, long-term finance, and the third, financial stability and regulation, with obviously knowledge management serving as a cross-cutting pillar. You can access thousands of news articles and publications on Making Finance Work for Africa's online library, mfw4a.org. And this closes our brief presentation of Making Finance Work for Africa. Also, before we get started, I would like to go over a few items, including the structure of this webinar, instructions on how you can participate in today's event. This is a message. 197 plus participants who registered for the event. The webinar will last a maximum of 60 minutes, including Q&A. For your comfort, participants will be muted. If they are not muted, please mute yourself. Questions can be submitted via one of the 2 panels on the chat or Q&A tab, or you can simply raise hand, click on the raise hand icon. Please also remember and mute your microphone after your question. And also, if you encounter any technical issue, feel free to send a message to the organizers. We have a team available for help. In case, yes, we'll be more than happy to help if there's any problem. Finally, the slides and the recording of this presentation will be available after we conclude on Making Finance Work for Africa website. Also, please remember to fill out the survey this webinar. The survey will automatically appear after the session. The survey is really important to us because it helps us improve the delivery of our webinars and to also identify relevant financial sector related topics to this. Thank you, everyone, for filling out the survey. And this ends our housekeeping. To our speakers, today we have Adam Beno. Adam is a senior associate with Riskera in charge of alternative investment services. And we also have Anyite, who is a junior associate with Rescura. Their presentation will last 30 to 35 minutes. We have a lot of good materials to cover today. And feel free to send your questions through the Q&A and chat panel throughout the presentation. And then we'll get back with the audience within 30 to 35 minutes for the Q&A. Gilbert, back to you.
Perfect. Thank you very much, Gabe. Really appreciate the introduction. And I just want to ensure that everyone can hear me. I'm seeing lots of comments that audio isn't working. Sure, just want to ensure that everyone can hear me. But thanks for the introduction. So hello?
Yes, Gilbert, we can hear you.
Oh, okay. Okay, perfect. Sorry, the screen froze on the other side. Okay, so let's get right into it. I think first and foremost, just want to introduce myself again. Gilbert's a junior associate, and then my colleague will be accompanying me on this presentation. Adam is a senior associate in the Alternative Investment Services Division. We are from Rescura, and just to highlight who Rescura is, and just give a bit of background of where we come from. Rescura is a global investment advisory firm. We are currently advising around about 2.3 trillion rand. We've been in operations for around 20 years. Have a total staff membership of around 130, and we service around about 26 African countries. We have operations in South Africa, Cape Town, Johannesburg, Botswana, Nigeria, London, Namibia, Kenya, and recently Hong Kong. Among some of the services in which we offer, investment advisory, portfolio construction, risk reporting, and investment research. So yeah, so that gives you a bit of background as to Rescura. So Adam and myself are from the Alternative Investments Services Division. And we mostly provide ancillary services to private equity and unlisted infrastructure asset managers. So we provide services such as valuation work, consulting, risk and performance reporting, financial modeling, and investment research. Okay, so to tackle the reason why we're all here today, our Bright Africa research. This research started in 2013, and the purpose of this research is to plot the investment landscape around the continent. As part of the 2019 year, we sought to increase the scope of the research in order to have a deep understanding of the investment characteristics around the continent. So the way we sought to expand our research is we will be speaking about investment in Africa by profiling the different African regions and understanding their risk characteristics and investment profile. We'll then be looking at sources of capital around the continent to try and understand where do the main sources of capital come from. And then we'll look at the different asset classes in which these sources of capital are invested in. So namely private equity, listed equity, sovereign bonds, infrastructure, and real estate. So to kick off with the investment in Africa. So what is also a bit different this year is we took a step back to try and understand who would find this research useful and who would truly benefit from this research. And in understanding that it was quite important for us when segmenting our markets and our regions in Africa is to try and find a way to compare them globally and not just stick within Africa. So what we did is we had a look at MSCI and FTSE's classifications of essentially economic development, where they looked at developed, emerging, and frontier markets. And these classifications largely stem from the sustainability of economic development, size and liquidity of capital markets, and the accessibility of those capital markets. So when we then look at the different African regions in which we analyzed, it became apparent that only Egypt and South Africa form part of the emerging market class, and the majority of the other African countries either form part of frontier markets or standalone, which means that from a standalone perspective, they haven't met the bench criteria for classification. So by then segmenting these markets and understanding their meaningfulness from a global perspective, it really helps us then analyze the different regions in Africa with their true global comparators. Okay. So to kick off, this graph that you're seeing speaks about the GDP output per region. And we broke down which are the sectors contribute the most towards GDP output across the different African regions. What we found from this is that the most important sectors is your agricultural, manufacturing, wholesale, and retail trade. And across the board, agriculture contributes quite a significant proportion to GDP, approximately over 20% for Nigeria, East Africa, Francophone West, Ghana, and other West Africa. We also find that extractive industries also contributes quite a considerable percentage for Maghreb and Central Africa, approximately 20%, which does indicate that these regions are quite reliant on extractive industries. And then looking forward, so that's one element of this graph, is to look at the composition of GDP. Next is to consider the different growth rates across the different regions. We see that East Africa, Francophone West, and Ghana have experienced quite high growth over the past year. In East Africa, the largest contributor to this growth has been Kenya and Ethiopia. The growth in Kenya mostly stems from a stable economic environment, positive investor confidence, and a resilient services sector, while the growth in Ethiopia largely stems from strong performance in the construction and services sector. On the other end of the spectrum, we've seen that Nigeria, South Africa, and Southern Africa have experienced quite low growth over the 2018 year. And Nigeria largely stems from high inflation, constrained domestic demand, and poor performance in the power and agricultural sectors. So now when we look at African exports by region, one thing that is quite important to note, and which this graph tries to highlight, is the concentration of exports to the extractive sector. So we can see that in Nigeria, Southern Africa, and the Maghreb region, there's a relatively high concentration to the extractive industry sector. And concerns around that is that ultimately where there's a high concentration to the extractives, it makes the exports quite vulnerable to the commodity cycle, to volatility in the commodity cycle. So we've seen that from 2014 to 2018, there's been around a 21% decrease in USD terms and the export value across the board. And this is largely due or driven by the volatility in the commodity sector. So in this assessment, we've looked at the relative wealth of individuals in various regions compared to the inequality of those regions. GDP per capita is our metric to measure the relative wealth, and the Gini coefficient is our metric to measure the inequality. So what we can see is if you look to your top right, South Africa has the highest Gini coefficient in Africa and in the world, in fact, and it also has the highest GDP per capita in Africa. So although it seems that there is quite a wealthy base or wealthy population, this wealth is really concentrated amongst fewer individuals in the population, so amongst your higher income earners. If we look lower to the right, you'll see that the Maghreb region and Egypt have relatively low levels of income inequality, so relatively low Gini coefficients, but high GDP per capita. So this is quite an attractive combination because it suggests that the relative wealth in the country is actually spread over a larger consumer base. So this provides an indication of a larger middle income base, which in itself supports a lot of your consumer-driven products and consumer-driven industries. So now when we look at Inter-Africa connectivity, so please don't get confused by this image. We do have a lot more detail in the report regarding the different types of infrastructure connectivity. But this image is just largely a placeholder to so you can graphically have a picture of the connectivity. So with respect to inter-Africa connectivity, trade within Africa remains poor, and so intercontinental trade is currently around 13%, and for comparative purposes, in Asia, this is around 58%, and around 70% in Europe. So we can see quite a stark difference in Africa when we look at our global counterparts. And major reasons for this is number one, the weak transport infrastructure. So with respect to road and railway, Africa generally has quite low road density as compared to Europe or Asia. And secondly, the high costs and prolonged time it takes to trade within Africa. This is typically 5 times higher than the US and around 100% higher than most other regions in Asia and Europe.
Just apologies, everyone. It seems like the connection is quite slow, which is why there's a bit of a lag when the slides are changed, and it seems like we're having some issues with the connectivity at the moment.
All right. So then next we've got sources of capital. And then we'll start with the pension systems when looking at the sources of capital. And what's quite important when analyzing sources of capital, and what we will see as quite a pervasive theme, is the distinction between the formal and informal economy within Africa. It is estimated by the UN that the informal economy accounts for 86% of the total economy in Africa, which is quite high when you're trying to understand that in context. And what that also means is that if we've got quite a high informal economy, then formal methods of saving would not be will not be high as a result. So what I mean by that is when we look at formal methods of saving, we're looking at the banking environment, insurance environment, and pension fund environment. And due to the large informal sector, it reduces the degree of saving in the formal space. So now when looking at pension funds and looking at pension systems, we start by trying to understand the relative size of pension systems in Africa. We can see that Southern Africa definitely dominates in terms of size. So we can see Namibia, South Africa, and Botswana have the highest AUMs across the continent and relatively high pension coverage ratios. The global average is around 60%. And we can see that only Namibia is above that for the 2018 year. But in these regions, what largely supports the high pension coverage is the public sector. So these regions have quite high public sector involvement, which then provides quite a bit of support to the large pension funds in these particular regions. And also to note, these regions also boast the largest pension funds around the continent. So in South Africa, the Government Employees Pension Fund is the largest fund on the continent with about 1.2 million active members and an AUM of around $125 billion. This makes up approximately 59% of the total AUM in South Africa and is also larger than AUM of a lot of other African countries. In Namibia, the pension industry is largely supported by the government's institution's pension fund, which boasts assets of around 7.6 billion and accounts for approximately 71% of total AUM in Namibia. What is also interesting to note from this table is that there's been quite a large drop in pension coverage in SA from 2017 to 2018. So this largely stems from low growth in South African environment. Low growth in the South African environment and a reduction in AUM in both USD and Rand terms. So now that we understand the relative size of pensions around the continent, what I alluded to earlier was regarding the informal versus formal economy. But that truly helps us understand, in this sense, why pension coverage is so low throughout the rest of Africa. So this map shows a proportion of the population age 60 and above in 2015 and the expectations for 2050. And it aims to illustrate the speed at which global populations are aging. And this really highlights Africa's youthful population and the growing middle class, which are generally considered positive investment themes around the continent. So it's quite interesting to note that the stark distinction between Africa and the rest of the world. Currently, less than 10% of the continent's population is aged 60 and above. And in 2050, according to United Nations research, Africa is projected to gain nearly 11 years life expectancy. And this map suggests that would truly be seen in North Africa and Southern Africa, as currently they boast the highest median ages as compared to the rest of Africa. And then lastly, in terms of pensions, we look at the pension fund asset allocation, and pension fund AUM allocation, and we can see throughout Africa that there are stark differences where we can see in Southern Africa, there is a bias towards equities, while in East and West Africa, there's more of a bias towards fixed income. In Southern Africa, boast far more stable equity markets, with attractive returns over the long term. So this explains why there would be a bias towards the equity markets. And similarly, in West and East Africa, equity markets are not as developed and not as liquid. And the fixed income markets will generally provide higher return and are more liquid and safer asset class. So it makes sense as to then why there would be a bias towards the asset class. Okay, looking at insurance. So I think we are running a bit over time, so I'm going to try and move a bit quicker through the rest of the presentation so that we've got enough time for Q&A. So looking at the insurance space, we've, for purposes of presentation, focused the presentation on the emerging markets, simply because there is quite a stark difference between the emerging and the frontier markets. The insurance industry is still largely underdeveloped in the frontier markets, so we focused on the emerging markets. What's quite interesting here to note is the size of South Africa in relation to the other emerging markets. So South Africa has the fourth highest insurance industry in the emerging markets class, and it has the highest insurance penetration and insurance density. And we can see from a penetration perspective that the life insurance is considerably higher than any other country in the emerging class. And that, to an extent, stems from social factors and also a high demand for life insurance and funeral products in South Africa. And then looking at the growth of this industry across the emerging markets, what we can see is that in general, there is quite a high correlation between the growth in non-life premiums and the macroeconomic environment. So thus, you'll find that positive economic growth generally supports positive non-life premium growth. So we can see this across the board, with the exception of Egypt, where we've got positive GDP growth and negative premium growth. And that largely stems from the underdevelopment of this industry. Egypt boasts quite a low insurance density and penetration. And then just to note that Russia has experienced the highest total premium growth. It's quite a standout, and this is mostly driven from increase in demand for loans and mortgages that have driven demand for life insurance products.
Okay, thanks, Gilbert. I'm just going to quickly speak a little bit about development finance institutions. So what we found is that many African countries are still struggling to access international financial markets to fund their development objectives. One of the critical issues is really around their sovereign credit ratings being below investment grade, which limits their access to international debt capital markets, as well as there's considerable budgetary constraints on public finances. And because of this, DFIs have played a significant or critical role in financing this gap and supporting Africa's developmental needs and infrastructure needs. Just in terms of the research and data that we were collecting on DFI commitments, just want to highlight that our data covers a significant portion of DFI capital flows, but several prominent multilateral and regional institutions were excluded, and the reason is just the way the information is presented and often aggregated makes it difficult to make direct comparisons. So, for example, some of the DFI flows don't include capital commitments from, for example, the European Bank of Reconstruction and Development and the IDC. So those are just some examples, but it does cover the majority. So if we look at DFI commitments by region, first of all, in 2018, total DFI commitments to Africa amounted to approximately $80 billion. The most significant DFI in terms of commitments was the African Development Bank, which committed approximately $34.1 billion, and this was followed by the IFC at $21 billion. In terms of regions, West Africa received the most in DFI commitments at approximately $21 billion. This was followed by East Africa at $17.3 billion and Southern Africa very closely at $16.5 billion. But just to note here that in terms of Southern Africa, this excludes some prominent DFI institutions like the IDC and Development Bank of Southern Africa and the National Empowerment Fund, which those three together dispersed approximately $17.1 billion in Southern Africa. So if we had included that, the region had attracted the most in DFI capital flows. But I think if we look at this graph and we see West Africa, East Africa, Southern Africa, North Africa, it's somewhat evenly dispersed. But if we were to dig down a little deeper and looking at DFI commitments to the specific countries within these regions, I'm just trying to move to this next slide. Again, I apologize, the signal is quite slow, so every time I try to move to the next slide, it lags a little bit. But in terms of the different region, the countries in the different regions, so if we look at South Africa, that's attracted the lion's share of DFI commitments. So out of the DFI commitments to this region, South Africa attracted approximately 70% of that capital at $4.6 billion. And then if we look at East Africa, Kenya makes up almost 50% of DFI commitments. And if we look at West Africa, Nigeria is prominent there at attracting $4.3 billion in capital, and that's just over 40% of DFI commitments. And Ghana attracted 36% of DFI commitments in that region as well. And then if we look at Central Africa, Cameroon attracted 47% DFI commitments. And then if we look at North Africa, Egypt accounted for 64%. So although if we look at a regional breakdown, it looks evenly dispersed, but again, if we go down a little deeper, dig a little deeper, those differences become a lot more stark when we look at the allocations to the specific countries in those regions. Okay, moving on to commitments by instrument. So from this slide, it's interesting to see. So except for the CDC, most DFI commitments are in the form of debt. This really reflects the nature of project finance, specifically for energy and infrastructure projects. DFIs also don't really have the internal structures and resources to provide substantial oversight that's really required when providing direct equity investments. So the majority typically provide debt financing. However, many DFIs have been successfully making equity investments by taking minority stakes, and in some cases, both debt and equity. But often it's indirect equity through their exposure into private equity funds. So they'll be investing into private equity funds that are making direct equity investments. But again, the interesting here to see is CDC is really quite different to the rest of the DFIs in terms of focusing more on direct and indirect equity, whereas debt financing is the norm for most DFIs. So that's just the DFI section. We're going to move on and to banks as the other source of capital, and I'm going to hand back to Gilbert. Thanks, Gilbert.
Perfect. Thank you, Adam. So in banking, essentially, we looked at clients' loans as a percentage of GDP as a metric for financial debt. And what we could see is that across the continent, this metric is quite low across the continent. And the main reasons or main factors for this is limited access to capital for large proportions of the population, relatively large size of the informal economy, which means a lot less use of formal saving mechanisms, adequate social security systems in certain regions, which is largely impacted by the degree of urbanization in those regions. And from a social perspective, the trust of these financial institutions. For interest's sake, there is quite high concentration in the banking sector. And we can see that South Africa, Egypt, Morocco, Nigeria, and Algeria, have the largest banking sectors in Africa. And on a combined level, if you look at the total assets, they account for about 83% of total banking assets in Africa. So moving forward, if we now look at listed equity, there is relatively, so what we can see from looking at the daily turnover by sector is that there's relatively low liquidity across.
Adam? Adam, I think you're on mute right now. Gilbert, can you unmute?
Can you hear us?
Yes, we can hear you now.
Okay.
Apologies. So we were talking about liquidity, and we spoke about how in the listed equity space that there's a low level of liquidity across the different exchanges in Africa. Then we looked at the cost of trading, and that showed us how high cost of trading is across these different exchanges. We can see that in general, brokerage commissions makes up the largest portion of the cost of trading, and it is a lot higher when we compare it to global and emerging counterparts. Moving forward, if we look at private equity, sorry, the graphs have gone, but we have the geographic focus, which looks at the level of investment activity across the continent. So we've seen an increase in 2018, and the majority relates to, or majority of investment activity relates to investments in East Africa and South Africa, with reduced investment activity in South Africa in 2018, but quite high increases in East Africa in 2018. Moving forward, if we look at the dispersion of PE investment activity across the different sectors, we can see that IT by far dominates the space. And this has been consistent for the last few years. And then this is largely supported by the emergence and increase of internet usage and smartphone penetration. And we're seeing an increase in investments in payment processes and integrated software and services. Moving forward, so we've been speaking about this for a number of years, about the conversion of listed equity and private equity prices. And we can see in 2018 that this conversion has arisen, where private equity prices have now slightly overtaken the listed equity prices. So when we look at the dispersion of private equity multiples across different sectors, we can see that there's a small dispersion where they are in a relatively small range. And what we can also see is that your consumer-related services are able to command higher multiples. And okay, so we are skipping sovereign bonds, apologies, just for time. And then I think we'll go to infrastructure. And in terms of infrastructure, what we just wanted to highlight here is when we're looking at the average time and cost of imports and exports, that in Africa, this is substantially higher than the rest of the world. So if you're looking at Asia or America or Europe, and this is what we alluded to earlier when we were speaking about interconnectivity in Africa. One of the reasons as to why there is relatively low interconnectivity in Africa is because of the high cost of trading within Africa. So this graph and the one below it, I just need to highlight those stark differences. And then lastly, if we look at real estate, so what stuck out to us in real estate is if we look in the office space and we assessed prime rental rates. So the growth in prime rental rates from 2013 to 2017 across the different regions. What we can see is that most of the major cities in Africa have seen a decline in their rental rates, with Nigeria being hit the hardest, Abuja and Lagos. And the reasons for this substantially relate to oversupply of new A-grade office buildings, which have inevitably depressed rental rates, and the slower uptake of these physical offices. What we've also seen is that Abidjan, however, has had the fastest rental growth in Africa over the past 4 years. And this largely stems from an increase in demand from for office space from international companies, which are requiring a larger presence within Abidjan. Okay, so thank you, ladies and gentlemen, for your time. I welcome any questions.
Yeah, and I think we just want to highlight, apologies that we ran out of time there, so we just skipped a few sections, and we were struggling with some of the internet connectivity on this side, so just apologies there with the lags in the slides. But yeah, I think we'll move to any sort of questions. So if you want to, so we'll hand control back to Making Finance Work for Africa.
Thank you, Adam and Gilbert. It's the Q&A session now. Feel free to send your question through the chat panel or the Q&A panel. You can also, if you join live and ask your question, click on the raise hand button and ask your question. But allow me to start with a question on, let's say, the sources of capital. Can you, this is a question for Gilbert, contribute if possible. Can you expand a bit more on the sources of capital, sources of domestic capital we have on the continent and how they're faring? So you spoke about those sources of capital, but can you expand a bit more on how they're faring?
Okay, cool. Not a problem. So within Africa, so as I alluded to in the presentation, typically when we look at sources of capital, we'll typically look at your pension funds, your insurance firms, and also your banking environment, as these are able to pull quite large sums from individual and then invest into capital markets. When we look at an African context, because there is such a high informal economy within Africa, these formal types of saving mechanisms don't have a large enough base to pull from because individuals in the informal economy aren't saving formally. So as we were showing in the different graphs and we're looking at the sizes of these various pools, that is why these pools of capitals are quite small in Africa. So when we're looking at the pension environment, we're looking at banking, and we're looking at insurance. When we look at the penetration of these pools of capital, they're quite small when compared to their global counterparts. And then that is why DFI has become such an important source of financing for investments within Africa.
Okay.
Hello?
Yes.
I hope that answers your question.
Yes, absolutely. Absolutely. Thank you. We have a question from Ali Dial. He has one question on Nigeria. Why is Nigeria not considered as an emerging market? That's his first question. And another question from Ali Diallo. Private equity investors, are they happy with their investment and returns in Africa overall? And also, do they consider the continent as attractive? This is a question from Ali Diallo to you.
Okay, perfect. Okay, I'll answer the first question, and then if you don't mind, when I'm done answering that, if you just repeat the second question again, you were breaking up a little bit. But to answer your first question, so we follow the classification criteria as per MSCI and FTSE. And what the classification criteria covers is the sustainability of economic development, size and liquidity of capital markets, and then market accessibility. So based on these criteria, and how it generally works is that they are thresholds that need to be met in order to be put into the relevant brackets. So from a, I guess, economic development perspective and the size and liquidity of the capital markets, Nigeria falls within the frontier classification as opposed to the emerging market classification.
Okay, and his second question is private equity. I'm going to read it. Hopefully you hear it clearly now. Private equity investors, are they happy with their investment and returns in Africa overall? Do they consider the and worth the risk?
So, in short, yes. How we see this is one of the slides spoke to, which speaks about the strong performance for private equity, and we can see that prices have been increasing. So we essentially analyze entry transactions on an annual basis, and we compare that to pricing on the listed market. So we can see the convergence between private equity and the listed market. And from the increase in prices, we can see that there is a growth within private equity investments, and that from an investor perspective, whenever you look at or consider the investor, you need to consider risk versus return. An investor will also consider the risk and growth potential in their investments. So we can see that although there are quite high risks with investing within Africa and within the different regions, investors are clearly seeing that the returns are worth the risk. The perceived return is worth the risk. So yes, so we are seeing that optimism in the private equity space.
And I think just to highlight as well, in terms of there is a significant amount of fundraising that has been occurring, and we've seen some records sort of breaking funds or private equity firms raising funds focused on Africa, which does show that there's still continued interest in investing on the continent and in investing in Africa's growth story.
Okay, yes, thank you. And you also have the message of thank you from Ali Diallo. So what you're saying is, if I want to follow up there, you're seeing an uptick in domestic institutional investors' involvement in private equity investment across Africa. Is that correct?
Yes.
Okay, and we don't. But I would like to follow up on this. What type of instruments? I think you spoke about the instruments favored by DFIs and others. But in terms of PE, are we still on the equity or more riskier instruments, or just or equity, or like mixed other instruments?
Yeah, so we've seen that it's still largely equity based and largely equity focused. We do have in the report, apologies, we haven't put it in the presentation. We do have a comparison where you'll find in the more developed space, a lot of the private equity transactions are quite leveraged, where in Africa it is largely still equity based, and that also speaks to, I guess, risks relating to servicing the debt with large leveraged transactions. So that's why they aren't typical from a pure private equity perspective.
Okay, I have another question on. You also mentioned the cases of South Africa, Mauritius, Botswana as the only countries whose coverage rate was somehow submitted by occupational schemes set up by employers. Can you also expand on the type of barriers to implement such schemes across the continent? In other words, why other countries haven't sued?
Sorry, you're breaking up a bit. Can you please repeat your question?
Yes. So in your report, there's a section stating that countries like South Africa, Mauritius, and Botswana are the only countries whose coverage rates was supplemented by occupational schemes set up by employers. So the question here is, can you expand on some of the barriers to schemes across the continent. In other words, why haven't other countries follow suit? Follow the example of South Africa, Mauritius, and Botswana.
So, sorry, just to expand, you're talking about with respect to the pension systems.
Yes.
So, in a sense, what's really driving the coverage in the pension systems is the public sector, right? So public sector involvement.
Yes.
So because there is quite a large public sector base within those regions, and for example, a lot of them are required to form part of the public pension fund, that then supports or really promotes the large coverage within those regions. So the large public sector base supports the large pension assets within those regions. So that's really what we've seen as a distinguishing factor.
Okay, thank you. We have a question from Stongbone. His question, I'm going to read his question. International financial institutions, such as the World Bank and the IMF, on the attention of the country of sub-Saharan Africa on the risk of the volume of external debts. What are some of your viewpoint on the question, and is a risk of failure or from these countries?
So the question is relating to, is there a risk that they'll not be able to service this debt?
That's correct, yes.
Yeah, I think what the DFIs are trying to do is they obviously are providing capital, first loss capital in many cases, and capital that's, although they require return, that the focus is development. And I think there is always a risk with countries, particularly that have that are running very large budget deficits, to be able to service not only the capital that's provided by financial markets, but also to service the debt provided by DFIs. So I think there is a risk there. I think that is a risk that the DFIs assess quite closely and track quite closely when they are providing their financing. And I think it's also the typical types of financing that provide is for projects typically like infrastructure projects that have a reliable future cash flow. So in that sense, they minimize or mitigate some of that risk. But I don't know if that answers the question fully. We can maybe follow up and get more information on that as well.
Okay, yes, thank you. Another question, apart from the impact of the global economy, what else is continuing to throughout Africa's ambitions? Do you have any idea about that?
Yes, so this is something we alluded to in the presentation, is that when we look at or consider Africa's trade potential, to a large extent, so if we break it down, so from an external perspective, as we mentioned, our exports are highly concentrated amongst the extractive industries and agriculture, and which then means that we're quite vulnerable to the volatility in the commodity cycle. So what then becomes quite important for us is to actually try and diversify our export basket in order to improve our global trade appeal. So that's one thing from an external perspective. Next, if we look internally, so if we're looking at now intercontinental trade, as we've stated, that this is quite low within Africa, and it's low for quite a few reasons. Sorry. So the one would be inadequate transport infrastructure and the high cost of moving goods between Africa. So again, it then makes intercontinental trade uneconomical and consequently unattractive. So those would be, when we look at our trade potential, those would be like serious issues currently affecting the continent.
Okay, thank you. Anything else we need to know about the report? This year you expanded a bit on real estate, and as opposed to last year. Do you expect something new on the next iteration of the report, the 2020 report? Do you plan to discuss any other pressing issue on the next report?
So we haven't looked at that yet. We haven't considered that yet. Largely, our process is to, once the research is out there, we analyze it as a team. We critically review it. Then we try to understand where to go from there. So we try to look at what is topical, what investors and allocators of capital are concerned about and worried about. And then we apply our minds to maybe research those particular areas in order to construct the publication. So as of yet, we haven't completed that process.
Okay. I think if you guys had any recommendations, in areas that we could provide further research, we'd be open to hearing those ideas as well.
Yes, absolutely. Yeah. We hope the audience will provide some inputs to the discussion and also to the scope of the Bright Africa report. But apparently, we don't have any other question, and we kind of run out of time. It's 5 minutes past the end time. Do you have any final word before we wrap up the webinar? If we have to, if we need one or a couple of key takeaways, what would that be?
Okay, sure. So when we look at things, so Africa has still got a long way to go when it comes to development. With respect to infrastructure, looking at our capital markets, looking at intercontinental trade, looking at the diversity of our local production and of our export basket. And these are structural areas where even small changes or advances will have quite large snowball effects. And then also, what is also quite interesting to note, and what has been quite pervasive during our research, is the size of the informal economy. The informal economy is quite large within Africa, and we need to think of ways to better tap into this economy, as this economy has a potential to serve as quite a substantial pool of capital. And then lastly, that the private equity industry continues to grow with deal activity still increasing, and we've seen quite resilient asset prices, even in the midst of increased perceived risk. So I think those would essentially be the key takeaways from the research.
Thank you so much. We are running a bit out of time. I'm going to thank you. Thank you, Adam. Thank you, Gilbert, for your presentation. Thank you for taking your time to highlight, to outline the findings of your report. The Bright Africa report is available on Riscural's website. Feel free to get a free digital copy. If you have any other questions, Making Finance Work for Africa, secretariat at mfw4a.org. Once the webinar ends, you'll see a survey on your browser, and we'll appreciate if you could complete the survey and provide your feedback. You'll also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. So thank you, Gilbert. Thank you, Adam. And on behalf of Making Finance Work for Africa and Riskra, thank you everybody for joining us today, and see you next year for the next Bright Africa report.
Bye-bye. Thank you.
Thank you very much.
Thank you.